How do business owners and CEOs increase their profits, increase efficiency, and reduce the amount of time they spend within the business, all while growing their net worth for eventual sale and exit? Our mission is to answer this question and unlock the secrets to success in the world of business transition planning. Welcome to Elevate Your Business, a podcast where we discuss valuable but sophisticated and complex growth and exit strategies and make them easy to understand. Join us as we talk to successful entrepreneurs, share new and profitable ideas, and help you to grow wiser and wealthier so that you can experience limitless success in both life and business. Here's your host, consultant, and financial planner, Adam Koos.
All right, everybody. Today we've got Andrew Doup with Syndication Counsel. Andrew's got a long career as an attorney working with owners, CEOs, companies that own real estate specifically. And he's got a pretty uncommon strategy that's becoming, I would say, becoming more common or more well-known, but still a very exciting, very new, cutting-edge strategy that's something called a qualified opportunity zone. And I would say well, tell me if I'm wrong, Andrew, but I think it's pretty safe to call you an expert in qualified opportunity zones. I mean, there's a lot of attorneys that call themselves generalists. You know, they do lots of different things. And this is what you do. You are an expert in the area of qualified opportunity zones. Am I wrong?
No, Adam, you got it. I mean, I would say I'm as much of an expert as anyone. Opportunity zones, they've been around only for a few years now, but I have been doing it as long as anyone. So we'll go with expert.
You got to be an expert. I mean, it's kind of like people who say they were a crypto expert in 2015. I mean, if you knew what crypto was, then you were an expert. But I think this is a little bit different.
That's right. Yeah, I mean, it is opportunity zones. You know, they involve a subsection of the tax code that not a lot of people have developed expertise in because it's so new and so niche. For me, the big opportunity was because of the clients that I was already advising in my private practice, which was comprised mostly of private investors, private business owners, folks who, would normally have no other choice but to pay a capital gains tax bill to the federal government. But after the tax reform in 2017, they were now given a new choice, which was to defer that tax instead of pay it. So long as you invest it into something called an opportunity zone. And we can get into what that means.
Well, we're going to get into it. That's for sure. This is exciting stuff for me because I love new trends and new strategies because they don't come about all that often. Things kind of, especially in the tax world and in my world, the financial world, you kind of have these strategies that stay relatively similar. The numbers might change, right? The caps might change, the maxes might change. But at the end of the day, it's the same strategy. And then every once in a while, once every decade or so, you get this new strategy that comes up that unfortunately too many people don't know about. So I guess what we'll say this episode's all about is people who don't want to pay taxes, or at least they want to defer taxes, and how to go about doing that in a way that maybe most people haven't heard of. So let's start with the basics. What is a qualified opportunity zone for somebody who has no clue at all?
Yeah, Adam, and I'm going to go one step further, and I'm going to go ahead and call this the greatest income tax incentive that has ever been legislated.
Okay.
So and by the end of this conversation, let me know if you agree with me or not. So let's start with your question. What is a qualified opportunity zone? A qualified opportunity zone is a low-income census tract that was designated by the Treasury Department to provide taxpayers with special income tax incentives that before 2017 didn't exist. So what are those special income tax incentives? There are two that we're going to discuss. And then there's a third kind of Easter egg tax incentive that not enough people are talking about. But the first one is deferral of a capital gains tax bill. So, as a taxpayer, say you sell a capital asset, whether it's, a painting or, an investment property or your business, normally you would have to pay, a maximum 20%, 23.8% check to Uncle Sam. That's your capital gains tax liability. Well, after 2017, Congress authorized taxpayers a choice. Instead of paying that tax bill, you can defer it until payment in 2027 on your 2026 annual income tax return by investing into opportunity zone business property. There are some rules that you need to step through in order to achieve that result. But the first one is first making the decision on whether you want to pay that tax now or pay it later. And if the answer is pay it later, then you would achieve that goal by investing into what's called a qualified opportunity fund. That's nothing complicated or mysterious. It can be as simple as a multi-member limited liability company. Just like any other LLC, it just needs to be treated as a partnership for tax purposes. There were then some rules on the type of property that you can and can't invest into with the pre-tax cash that you invest into that OZ fund. But the second tax incentive and what most clients are really excited about is the prospect of 100% tax-free exit after the 10th anniversary of your deferral. And this income tax result, this tax-free exit, it does exist in a couple other places in the tax code. Really hard to get. This is the only place.
Let me stop you there real quick, just because I want to. I don't mean to interrupt, but I want to make sure that before we move on, that we make a differentiation between the deferral of capital gains tax initially to a certain date, and then the tax-free treatment of that money after 10 years. So can you explain to our listeners, our viewers, kind of what the difference is between those two things, or how they're different or similar for that matter, just to make sure they understand?
Yeah. So deferral just means you don't have to pay your tax now. You have a tax liability. Normally under normal circumstances, you would have to pay it in your current tax year. But if you elect to defer it, then that is a temporary deferral. You could defer it until payment in 2027 on your 2026 annual tax return.
Okay.
So that's we're coming up on 2024 now. So that's a 2-year deferral, which most clients look at as a 2-year zero interest loan from the government.
Mm-hmm. So when you look at that deferral, in 2 to 3 years, they eventually have to pay that cap gains tax, right? So they're not avoiding it; they're just delaying it. Correct?
That's right. Yeah.
But then the appreciation, the second piece, then is the appreciation on the asset you're purchasing for 10 years. If held for 10 years, there is no cap gains and no tax owed on the proceeds of that once sold. Correct?
Yes, that's 100% right. Yes. And so, what that presents is a, tax planning opportunity for folks that decide to make this deferral election. You have 2 years, to plan on how to pay your deferred tax bill. And, clients take different approaches to this. And a lot of it is driven by the asset class that they're investing into. So, say, for example, you decide to invest into, a multifamily apartment in an opportunity zone. Within 2 years, you may look at a refi, using those refi proceeds to pay your deferred tax bill. And then, continuing to hold that asset for the next 8 years, you could then sell it and achieve 100% tax-free exit on the sale. So that's the second benefit, what most clients are excited about. I mentioned this third incentive, which is kind of an Easter egg incentive. But normally, a sale of a capital assets, let's use property, for example, it would be subject to depreciation recapture. So any depreciation deductions you took during the period of ownership and that you had a place in service, you'd be taking depreciation deductions to offset your income tax. And normally you would have to recapture those depreciation deductions when you sell the asset. The way the opportunity zones rules work is that you get your tax-free exit exempt from depreciation recapture. So there's just a ton of tax yield for investors who place pre-tax capital gain into opportunity zone investments.
And for people who don't understand that depreciation recapture is basically you're getting a depreciation today on an asset that you own, and that helps save taxes today as you grow your business. But when that asset is sold, you then have to pay tax on that recapture, and this is a way to avoid that.
Yeah, that's exactly right. Yeah, so those are the three income tax incentives that opportunity zones offer. Opportunity zones, I mentioned, they've been around since the 2017 tax reform. So they've been in place now for a few years. Our clients, initially, were real estate developers, developers who already happen to have a project in an opportunity zone. They said, hey, we've got this new legislation. Let's take a time out and figure out how to unlock these income tax incentives for our investors. And so we did. But as you can imagine, this what initially began as a niche practice with local clients has quickly grown into a national practice with clients across the country. And so, let's take a step back though from the incentives and talk about the public policy behind the legislation, because that's also an important piece to making this work. And, the general idea is, hey, like we've got these low income census tracts that, all these, reports that have been published by economists show these census tracts specifically have not recovered from the Great Recession, from the financial crisis. And not only that, but they've actually done worse. Mm-hmm. So as public policymakers, like how do we incentivize private investment into these areas of the country, into these communities that need it most? The solution is this incentive, this tax incentive. So they call it opportunity zones. The idea is, hey, taxpayer, rather than pay your capital gains tax to Uncle Sam, instead take it and invest it into these communities that need it most, and make a difference, whether it's in your local community or elsewhere. That's the public policy idea behind the legislation. So it's a social, there's a social impact aspect as well.
Many people, I think, are afraid. Not afraid, probably the wrong word, but they don't want to sell something many times because they don't want to pay that tax. So they just hold on to it, maybe for too long. Here's an opportunity to, and hence the phrase opportunity zone, right? Here's an opportunity to sell that, defer the capital gains profit that you would otherwise have to pay tax on that profit, put it into something else that gives you an opportunity to not only grow in a new area, or maybe technically be an older area usually. And by the way, total side note here, I've looked at some of the opportunity zone maps, and some places I'm shocked they're considered opportunity zones. They don't seem that bad, which, that's a good thing, right? It's the think, okay, well, it's considered an opportunity zone, but it's not like we're not talking about a rundown area necessarily. And then you buy the property there, it appreciates, you sell it down the road, and you don't have to pay any tax on the property. And that's huge.
Yeah, that's right. To your point, and I think part of the reason why real estate developers were kind of the first class of entrepreneur to take advantage of this section of the tax code was because they were already developing properties in opportunistic geographic locations. Right. So, like where they see value, for a return on their investment was where they were already investing. Now they've got, this public policy behind, this activity as well, just providing incredible tax yield to investors.
What are the different types of OZs available aside? You mentioned multifamily as an example. What are some other examples of investment types that people would choose to invest their money in?
Yeah. So, when I'm having a conversation with a client about opportunity zones, if they come from real estate, they may already be familiar with a similar deferral mechanism in the tax code, 1031 exchange.
Yep.
So, it might be useful to compare and contrast with the 1031 exchange for real estate, because they're similar in that they both offer a deferral of a capital gains tax bill. But they're also very different in that opportunity zones are just a temporary deferral, whereas 1031s are permanent. Another big distinction is that because it's a temporary deferral for opportunity zones, you then get the benefit of the tax-free exit within your lifetime.
Right.
Whereas, common criticism of 1031 exchanges is that, you don't during your lifetime. Yet, you're
going to die with it.
Beneficiaries might, but you don't. So, I mentioned developers being the first entrepreneurial class to use opportunity zones. That may be another contributing factor. But they have used it for across asset classes, whether it's multifamily, industrial, hotels, commercial. There is no restriction on asset class. And another big contrast to 1031 exchanges, there is no restriction on real estate, on like-kind property. So if you've deferred gain into an OZ fund, you can use those pre-tax cash funds to invest into a real estate project, but you don't have to.
You mentioned art too, where the 1031s used to be, you could sell a business and you could 1031. You can't do that anymore.
That's right.
So now you can sell a business. Would that be accurate?
You can. Yeah.
You can sell a piece of art. I mean, that's could be highly appreciated stock. Yep.
Yep. Crypto when crypto had gain, any gain you can defer and invest into an OZ fund, and then use those funds to then invest into OZ investment property. And as I mentioned, it's not limited to real estate. You can invest into operating companies, into startups, into any tangible business property, so long as it's got some nexus to an opportunity zone. And there's some complicated rules that we can dive into, but I'll spare you. I'll spare you from that. The general rule is that it's got to have some nexus to an opportunity zone, which for real estate means it's located in the opportunity zone. For an operating company, in contrast, an operating company is going to be shipping, products and widgets, outside of the opportunity zone, and that's okay. So long as at least 50% of the receipts are derived from products made within the opportunity zone, or management, at headquarters is located within the opportunity zone. Without getting too deep into the weeds, the general idea is that Congress offers these income tax incentives to improve and to attract investment into these low income census tracts.
I'll have to see, and Kyle, our producer, I'll see if we can't throw in some maps. If I can get a couple from you for maybe Columbus, Cincinnati, Cleveland, and maybe a big map of the United States or something like that. That just kind of highlights all the areas where opportunity zones exist, because I think that'd be really interesting for people to see. I've seen them before just because I've Googled them, and it's just super interesting to see where they are. Some of them could be right next door to you and you wouldn't even know. I mean, it's really interesting.
Yeah, you may, if you're a business owner, you may already be located in an opportunity zone. You just,
right.
It's never come across your radar before. But you're right. Some of these have been designated in surprising areas. The reason why is because the Treasury Department, in their designation, they use 10-year-old census data. And in a lot of these cases, some investment was already underway, and this has just propelled it to another level. Opportunity zones, they do exist across the country. There are over 8,700 opportunity zones across the country, and the Treasury Department has a map that you can go on to, and it's like Google Maps, so you can zoom in, zoom out, and scroll and find one.
Well, this might be kind of a redundant question, but I mean, who does this type of strategy make sense for? I've heard you say, business owners selling their business, real estate investors selling their real estate, people who collect art. I mean, who else is there out there, or have we covered it?
It's more general than that. Really, it's for anyone who has realized a capital gain tax liability. They should be of any kind. Yeah, they should. This should be something that they should be asking their professional advisors about, so that they're determining whether or not it's a suitable, not just tax planning strategy, but also future investment and family legacy planning strategy as well.
Yeah, that kind of DSTs are a conversation for another day, but that kind of reminds me of using 1031s and DSTs as an option, which I think would marry perfectly with this strategy, depending on the person in question and what their asset is they're selling. I've got a big question for you, and this one's probably going to take you a while to answer, because you and I have talked about it probably 3 times now in the last 6 months. But could you go through kind of one by one? I believe there's 3 different types of qualified ways to invest in qualified opportunity zones. Am I wrong? Is it 3? Is that right?
Yeah. No, that's generally right. So I'll just walk through this, because this is the same conversation that I have. With clients that. So we just discussed who should be paying attention to this. The answer is anyone who's subject to a capital gains tax liability. So the next question is, what approaches are available for me to choose from? And the answer is there are really 2 approaches, and Adam, you and I will talk about a third approach. But the first approach is look at your capital gains tax bill. If it's cap gains tax rates are at historic lows, so may not like paying the tax historically is not a bad option either. However, deferring the taxes is always a good option, right? And so,
pay it later.
Right. And again, unlike the 1031 rules, it's not an all or nothing proposition. You can pocket as much of your cap gain as you, or as little as your cap gain as you want, and then defer the rest by investing into an OZ fund. So that's kind of step one, is determining what your individual cap gains tax liability is. Step two is then deciding how to invest it. So you can invest it into either your own, we call it a self-directed qualified opportunity fund. This can be something as simple as a 2-member limited liability company that's been organized and is operated as a qualified opportunity fund for tax purposes.
It has to be 2?
It has to be at least 2.
Okay.
And the reason why is because these LLCs need to be treated as partnerships for tax purposes.
Should they be a married couple?
Can be a married couple.
Okay,
yes, so long as you have two.
Found a loophole.
Yeah, no, that's right. Yeah, and that's that's a strategy that a lot of clients in that demographic take is if they have a large enough capital gains tax bill that it warrants forming their own self-directed qualified opportunity fund, is because they're thinking about it as a family estate planning vehicle, and so they're building a team around them to help them achieve compliance with those tax rules, to file all the the forms that need to be filed with the IRS to make their deferral election, and then they're also consulting with their wealth planners, financial planners, on identifying an alternative investment to then place that investment of pre-tax cash into. So that's kind of the first step that you can take.
Which, to recap, is having your own LLC and basically buying your own property, correct?
So not quite yet. It's forming your own LLC as a qualified opportunity fund.
Okay.
Kind of like, think of it similar to a self-directed IRA.
Okay.
All right. So you retain control over it. And in fact, you have even more control over it because there are no restrictions on what you can do with the money outside of investing into opportunity zone property. So you have total control of the funds when you transfer them from your personal account to the account of this qualified opportunity fund. You then have until year end or 12 months to make your investment into opportunity zone property.
Yeah, plenty of time.
Yeah, it is.
So money goes into the LLC. You set up the LLC. Money goes into the LLC. You have 12 months to invest the money in something that qualifies.
Yeah, the general rule is 12 months. Could be more, could be less, just depending on the time of year that you make your investment into your self-directed qualified opportunity fund.
Okay. A lot of control there in option one.
Lot of control, a lot of option, which is why it's often the preferred option for folks that have a 6, 7, 8-figure capital gains tax bill. They want to keep control of their funds and they want to point to where they want it to go, rather than place it with a fund manager who then makes that decision for them. Now, the downside of that approach is that, with control comes responsibility, where, you have to ensure that, you're complying with the tax rules, that you're filing the forms that need to be filed with the IRS. So there is some additional work there. But you can find the right team, to take care of you. But there are also some clients who just they want to be more passive than that, and that's fine too, because there are third-party professionally managed qualified opportunity funds that are raising capital, pre-tax cash from investors who want to be passive. And these are all private qualified opportunity funds. So that's more of a hands-off and passive approach, where instead of forming your own self-directed qualified opportunity fund as your family estate planning vehicle, instead you're placing it in the hands of someone else to take care of that for you.
It's like a mutual fund or ETF. Not the same.
Private. Yeah.
Conceptually, though.
Conceptually, it's going to be privately held.
Right.
So these are all private placements.
Yep.
So that's the second option, because, the benefit of that approach is that, you don't have to worry about it, hands off, you've got it with the professional. Of course, you're still going to have to work very closely with your financial planner to make sure that you're doing your due diligence up front on fund managers that you're trusting with your cash. And you're going to want to ensure that they've got a plan in place for you to help cover your tax bill, because again, it's just a temporary deferral. It's going to come due and payable in 2027 on your 2026 annual return. So those are generally the two routes that you can take. There's a third one, Adam, that you and I have discussed, and it's one that my RIA and CFP clients consider. And it's, I've got these advisory clients. If I've got one client who's got a cap gain and they'd rather defer the tax than pay it, then why don't I form a fund for them, and why don't I then invite participation by my other advisory clients? So that this way, I can advise them on, like which investments are best suited for their individual investment goals, both short term and long term. I mentioned the tax incentive that most clients are excited about is this prospect of a 10-year tax-free exit. Right. So that, like, you're going to need
while you're alive.
Yeah, while you're alive. But these are investments of pre-tax cap gain, and because the exit is tax-free, you're going to want to choose the investment that is best suited for your individual investment goals, whether it's because you're looking for periodic distributions of passive income during that 10-year period, or if you're not really interested in that, you're more interested in a tremendous tax-free upside. Those are some considerations that are going to be different for every investor, and it's a conversation you want to have with your CFP.
Yeah, that's great. What trends would you say exist? I know we're talking about a strategy that's been around for 5 or 6 years is all. What do you see this going? How do you see this? How do you see strategies changing, or tax laws around QOZs or anything? When you look out into the future, being that, this is what your focus is, this is what you do all day, every day.
Yeah. So you're right. This legislation has been in place for 4 or 5 years, and it sunsets in 2027 or 2026. The benefit of deferral goes away, and opportunity zone designations go away in 2028. So there's some legislation that's been proposed in this Congress and in the previous Congress to extend these tax incentives. I was in DC last week for an opportunity zones conference, and congressional representatives were there, and this is now a $40 billion industry.
Right.
And the question is, it's November, are we going to get these extensions prior to the end of the year? The answer is, they don't know. They don't know. They don't know. They need a vehicle to push for these extensions to ride through Congress on, and they don't know if it's going to happen. In the next 2 months. 2024 is an election year. Nothing's going to happen there. So the benefit of deferral goes away year-end 2026. If any extension is going to happen, it's got to happen in 2025. Would really be the last chance, because that's when a lot of other provisions in the Tax Cuts and Jobs Act sunset. So that would be, if there are any changes that are going to be made requiring an act of Congress, likely it's going to be in 2025, but it may not be. And so what that means is, I mentioned, in my opinion, this is the greatest income tax incentive ever.
Yeah.
And it could be around only for a limited time. Which means if you do have cap gain, maybe worthwhile creating your own self-directed QOF just so that you lock in the benefit. Because, that QOF, I mentioned, funds have to be in there for a minimum 10-year period. You hold your investment for a minimum 10-year period, but you can hold it much longer than that. And in fact, it might make sense to hold it much longer than that. If you're looking at this as a generational, wealth planning vehicle, you can ride the benefit of this tax-free exit until the year 2047. So what that means is that you set this thing up, you invest into an asset, you don't have to hold that single asset until 2047, or for 10 years even. You just have to hold your interest in the OZ fund for 10 years. So you can buy and sell assets with your fund during that interim period, continue to grow the value of your portfolio for as long as you want, up until 2047. a lot of the clients that I'm working with that, have this long range vision, that's exactly what they're doing. They may be entitled to a tax-free exit after the 10th anniversary of their investment, but, their time horizon is much longer than that because, again, best tax incentive ever. They don't really see the need to cash out prematurely.
Well, there's you could have a fund that exists for many, many, many years, beyond 10, 15, 20 years. And so I'm hearing you say that really the tax savings is based on when the asset's sold, being 10 years, of course, not so much how long you have the fund's been around or needs to be around, right? So the QOF, as you put it, the Qualified Opportunity Fund, can be around for what you said, as long as 2047 is the current limit.
2047 is when you would need to sell your interest in your OZ fund by 2047.
So, but if you defer cap gains in 2023 before year end, and you sell that asset in 2034 in January, then you're exited. You paid your cap gains maybe 3 years later that you deferred, but you sell whatever appreciation you've accumulated in that asset. You sell that tax free inside that fund. Yeah. That's awesome.
That's right. Yeah. So you can take your chips off the table tax free at that point, or you can keep them in.
Yeah.
Right. And keep growing the value of your pre-tax investment.
Yeah. And then what kind of support do you feel like this is getting? So when you're in Washington, do you feel like it's getting enough support to where it'll get extended, or is it just too tough to say?
I think it's a piece of a larger conversation, about income tax incentives. And I don't think anyone knows what that conversation is going to be in 2025. But this is, I mentioned, this has grown into a $40 billion marketplace of private investment. These aren't publicly traded stocks. This is all private investment activity. I'm hopeful that this money, it's going to the communities that need it most. Right. So, I mean, it scratches, the back of both parties, both sides of the aisle.
Right.
And that's how it is. I mean, and that's how it was introduced, initially. It had bipartisan support, bicameral support. And nothing is going to happen during the election year, but I'm hopeful that, the spirit of, bipartisan cooperation comes back around in 2025 so that we can renew this and we can renew some other really, really powerful income tax incentives that were introduced by the Tax Cuts and Jobs Act just as well.
Wow. Yeah. This is exciting stuff. We're going to have to jump on and do another episode comparing 1031s, DSTs, and QOZs, and maybe talk about some state tax credits too. We'll have to talk about that another time. That's an episode all by itself.
It is, yeah. But I tell you what, that's another trend in this marketplace is, we're here in Ohio, in the Buckeye State, and we're unique on a national level in that we're the only state that has a tax law that complements the income tax incentives. So here in Ohio, not only if you're investing into an Ohio Opportunity Zone, not only are you eligible for these federal income tax incentives that we've discussed, but you're also eligible for a 10% state income tax credit as well. And what makes this state incentive special is that the state of Ohio doesn't care if investors are investing with pre-tax capital gain or post-tax cash. If you're taking the risk of investing into these opportunity zones, then you're equally eligible to apply for this 10% state income tax credit. So it's a wonderful incentive. Not every state, as you can imagine, is as friendly as Ohio when it comes to business investment. In California, for example, their state tax code does not couple with the federal income tax code. So you're still going to be subject to state income tax in California. In Ohio, by contrast, not only are you going to be exempt, but you're also going to get this additional 10% state income tax credit.
So it might be cold in the winter, but there's no death tax here, and you get the 10% deduction on your state tax for QOZs. See, that's not all that bad. It's not all bad.
It's super clever approach by our General Assembly to they want to bring out of state dollars into the Ohio communities that need it most, and based on what I'm seeing in the marketplace, that public policy is effective. Very effective.
Everybody knows about Intel, the Honda subsidiaries. I think it's working. That's working.
Right. Yeah. That's right.
Well, Andrew, thank you so much for joining me today. We got Andrew Doup, I would say the subject matter expert in Central Ohio, if not all of Ohio, on qualified opportunity zones. You can get a hold of him at andrew@syndicationcounsel.com, or just head over to his website at www.syndicationcounsel.com. You can message him there, check out his website, learn a little bit more. And if you'd like to set up an introduction call or an introduction meeting, Zoom meeting, he'd be happy to talk to you more about this and your personal situation, confidentiality. So thank you so much, Andrew, for joining us. Really appreciate it.
Thanks for having me, Adam.
Thank you for joining us on the Elevate Your Business podcast. To complete our free business valuation quiz, to check out additional articles, webinars, videos, and other educational resources, or to set up an intro call with your host, Adam Koos, just head over to elevateandexit.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for financial advice. None of our shows engage in rendering legal, financial, tax, or other professional services. Always talk to a professional business transition planning consultant or certified exit planning advisor before implementing any of the ideas shared in this episode.